If you ask small business owners how they measure their financial success, the first answer is always revenue. How much came in? Did sales go up? Did we beat last year's revenue numbers? I understand that. Revenue matters. And of course, it's the biggest number on your profit and loss statement. So, of course, people are going to gravitate towards it. But if you want to build a business, a stronger, more durable, more valuable small business, revenue is not enough. At some point, you have to shift, maybe even progress from thinking top line revenue to thinking bottom line profitability. Revenue may tell you how your business is doing. Is it active? Is it growing? But it's profitability that tells you whether your business, is actually working. That is one of the major themes in my new book, The Founder's Treadmill. In year one, two of the earliest upgrades are upgrade number 2, set up the proper entity structure and tax structure. And upgrade number 3, install a professional cash flow system. Those are just 2 things, and those 2 things belong together because once you set up the right entity structure, you can start thinking like an owner of a real business, of equity, not just a hardworking operator trying to survive and pay the bills. In another of my books, Building with the End in Mind, I made this point more directly and maybe more powerfully. Annual gross revenue is often the primary measurement tool for sole proprietorships. But profits are the primary measurement tool for business owners. That distinction matters a lot. A business can have impressive revenue numbers and still be weak. A business can grow and still not produce real value. A business can keep the founder very busy and still not be worth much. Why? Because if all the money gets consumed by overhead, owner withdrawals, tax efficiency, or a lack of cash flow discipline, then growth is not building much of anything. It's just creating motion. Profitability is what changes that. Profitability matters because, well, it does at least 4 important, dare I say, critical things, at least from a business owner's point of view. So let's do this already. 1, 2, 3, 4. First, I often hear small business owners arguing that, hey, after expenses are paid, it all goes home anyway. That's missing the point, I would argue, and an important one at that. That is owning a job thinking. In a business, wages and profits, 2 completely different functions. And later on in this video, I'll explain that even the IRS sees it that way. Wages are for the work you do. Profits are a return on your investment, or ROI. It's for the risk that you've taken to start a business. During tough times, those profits may indeed ebb and flow or be reinvested. But your work should always be compensated. It's part of what happens to the revenue as it moves through your P&L to that bottom line number, your profitability. Owners get paid too. That's number 1. Number 2, profitability is what creates value. In my book, Building with the End in Mind, I wrote that from an appraiser's point of view, the bottom line of the P&L is the starting point for building a valuable business. That is a major issue or point. When new investors or buyers or even lenders from a bank, future owners look at your business, they're not asking, how busy is it? They're asking, what's left over after everyone and everything else gets paid? Can the business operate profitably, competitively on that front? And that is where value begins. Third, profitability makes a business investable. Now, a lot of small businesses don't tend to think this way, but I think you should. If you ever want a key employee, a son, a daughter, a next generation owner to invest in the small business you founded, they need to see a real ascertainable financial reason to do that. Well, of course they would. They need to see that ownership is more than a job title and certainly more than wages and benefits. You don't need to make an investment and take a risk to get wages and benefits. These investors, your future investors, they need to see that there is an actual return on the investment risk they take. In my book, Building with the End in Mind, profitability is one of the 5 core attributes I lay out for an equity centric business, right alongside value, growth, sustainability, investability. It's not an accident. A business that does not produce profits is hard to sell, it's hard to buy into, it's hard to finance, and it's very hard to perpetuate. And fourth and finally, profitability improves tax efficiency when you get that entity structure right. As I said earlier, entity structure and business value, they go hand in hand. But value goes back to bottom line numbers and thinking. This is where small business owners really need to pay attention. So stay with me just for a few more minutes. If you are operating through the proper tax conduit or flow through entity structure, the profits, they don't just vanish into some distant corporate box or line item on your tax return. They flow through. They come home. And in the case of an S corporation, at least where reasonable compensation is properly handled, those profit dollars are often treated more favorably than wage dollars due to self-employment tax purposes. This is what I mean by wages are for a different function than profits. And you use the right entity, the IRS will agree with that, and they'll tax your profits differently and often lower. That's a big deal if you grow fast and are very profitable over the course of a career. Now, before we move on, just pause here for a moment. If you can take your profit dollars home, often as much as half of your take-home pay, let's call it. So let's say we have 50% overhead, and then we take 25% out of the money for owner's comp, and the last 25% is profits. So for every dollar that goes out as wages at a higher tax rate, another dollar goes out as profits at a lower tax rate. That's worth thinking about and running the math and doing the numbers on. Take it home at a lower, more efficient tax rate. That only makes sense. As a sole proprietorship, you lose that opportunity. You need an LLC S Corp or a garden variety S Corp to get that done. And that's one reason your choice of entity structure matters so much. If profitability is the goal, you need to get this part right. In the founder's treadmill, upgrade number 2, which happens in the first year of the rebuild model, it happens before upgrade number 3, which is getting your cash flow systems right. Why? Because you first have to set up the entity and the tax structure, and then you install a professional cash flow system to work within that legal structure. That's the right order. The structure and the cash flow have to work together, but you can't do much with the wrong entity structure. In Building with the End in Mind, I use something I call the 3-basket cash flow system. This is something you'll want to think about and know about. It's not difficult, but it's often a different way of thinking for many small business owners who like the sole proprietorship model. So we're going to talk businesses, 3-basket cash flow system. Again, let's just think this out for a minute. If you still operate as a sole proprietor, by comparison to an S Corp, let's say, then you run what I call a 2-basket cash flow system. This will seem real natural and normal when you understand it. For example, if your overhead, again, is 50%, well, then all the rest goes home, arguably. That's 50% to basket 1 and 50% to cash flow basket number 2. But everything that goes home in basket 2 is taxed at ordinary income tax rates. Yeah, there are wages in there. Of course, there are profits in there. From the IRS's point of view, it's all the same. And it's all taxed the same as ordinary income. That's why having a separate 3rd basket in the right entity structure changes everything. model we're talking about should help you as a small business owner see something very important. In addition to the arguments I've laid out so far, I want you to consider that not every extra dollar should be treated as owner compensation. Some of it needs to remain as a profit. Some of those profits need to be retained to strengthen the business. The word is reinvested. Some of it needs to support value, future growth, future ownership. That's how you move from I own a job to I am building a valuable business. And this is also why so many founders struggle, at least at first. In the early years, it is very natural to think and act as a sole proprietor. I did. You work hard, you bring money in, you pay the bills, and whatever's left feels like yours. But if you want to own and run a real business, one that becomes stronger, more valuable, and less founder dependent, you have to outgrow that thinking and that mindset. You have to start asking, what is my actual profitability level? Is it competitive? Am I tracking it consistently? Is it growing? Am I making spending decisions with bottom line profitability in mind? And if you want future owners to join you one day, younger next-gen partners, maybe even a family member, is there enough real economic value here for them to invest in your business? It matters, and they're going to care, and it's hard to fix in the short term. Best start now. Bottom line, pun intended, that is why profitability matters so much. It's not because accountants like it or say you should. It's not because it sounds sophisticated. It's because profits are what make a small business stronger, more valuable, more investable, and more durable over time. Closing thought, a lot of founders chase revenue. Smarter owners learn to build for profitability. And the sooner you do it, the better. Because revenue creates motion, profitability creates value. And that's what the future is all about. Thanks for listening.